After a period of de-escalation that seemed to settle the markets, we're now entering a stage where concerns over American tariffs, along with Trump's so-called big, beautiful bill, are now roiling markets again. Let's go to Pierre Ouimet. He's head of investment strategy at UBS Canada, and he joins us to talk some more about this. Thanks for joining us today. Let's talk big picture first, if you don't mind. What are today's moves in the markets telling you?
Well, the equity market doesn't like higher rates. It's quite simple. I think it's right now it seems like fixed income is calling the shots for the equity market, and the fixed income market is starting to wake up after a while. I mean, we're all wondering at one point in time, when is the bond market going to send a message to the administration that these consecutive deficits year in, year out are just not a recipe for long-term success. So we're starting to see that right now, which means the risk premium is going up, which doesn't bode well for the long-term perspective on interest rates. On top of the fact that these tariffs, now EU 50% tariff, okay, I mean, we've heard it before. I mean, yeah.
Okay, so let's
scare the living daylight out of them, and then try to get something more. Yeah. But it's, I mean, the tariff is, U.S. tariffs can end up between 10 and 15%, which is going to have an impact on inflation, which is going to push the Fed into a bad position of not really being able to compromise you over the shorter term. And if on top of that, the bond market is trying to get it jitters because there's no resolution on the part of politicians in either House or the administration to do anything about these ongoing deficits. So it's I guess you could call it business as usual in Washington.
Let's talk a little bit more about what is being referred to as the big, beautiful bill that is moving forward through the U.S., through their system there. We know it has implications for Canada, but you don't think, obviously, it's enough to sort of quell some of the fears about American debt overall?
No, au contraire. I mean, it's going to add $3 to $4 trillion to U.S. debt over the next decade. So it's, I mean, do the math. That's 300 to 400 billion a year. So it does nothing. Actually, it's more of the same. And I think that's why Moody's, rating agencies, and the bond market are worried. That's just it has no relation to reality. Politicians should start to wake up and do something about it, because it's going to be a huge burden on future generations, and that needs someone to realize that. In face of the fact also that Medicaid, Medicare, and Social Security, they're facing a wall come the early 2030s. They're just going to run out of money. So it's something has to be done, and nothing's being done. So it's again, it's always kicking the can forward and hoping for the best. Well, the bond market is finally telling the world and politicians in particular to stop doing what they're doing.
The bond market has been sort of going that way for a while. I'm just wondering why you think they're not listening, because initially we know, or many people expected this government to be very aggressive, cutting the deficit, cutting the debt, and we know that they're making these cuts to government spending. But is it just the offset of the tax cuts that are not sort of going to do the job that cutting government spending people thought it would?
Well, obviously they're not cutting sufficiently, and I mean, the U.S. are great at spending money, but when it comes to taxation, I mean, they're not very good at it. And Trump's solution to the whole problem is tariffs. And we saw the first month of these tariffs and brought in $116 billion or something, annualized maybe 200. As a going rate, we think it'll probably be $300 to $400 billion or something like that. So it's not going to make and it's already factored into this budget bill. I mean, it's big, it's beautiful, and it's a bill, but big, that's for sure. And it's just more of the same, and that's what the bond market is kind of fed up with that. And we're seeing the same thing happen in Japan. Of course, their debt situation is worse than the U.S. in terms of debt to GDP, but there's no reason why interest rates in Japan should be running up, and they are, because there's sovereign debt risk is a very, very significant risk. I mean, I've been arguing that something should be done about it, and we should be striving towards balanced budgets, at least a path towards balancing the budget. But there's none of that in this bill. Actually, it's just more of the same, and even worse. And we're on the same trajectory here in Canada with what the Liberals are proposing. So it's
I just want to get to some investment strategy from you, if you don't mind, given sort of everything that's moving. So what are you advising investors? Where should the money be going?
Yeah, we're continue to tell people to stay invested. I mean, it's not necessarily going to be that much of an impact on equities, but I think what we're seeing on the equity side is we're starting to see downward revisions, and the earnings they're going to be somewhat disappointing as we go forward. The U.S. economy is going to slow. We have 1.5% growth this year in the U.S., and Canada is. I hate to say it, but I think Canada is as close to a recession as we can get. And, that's all going to have an impact on earnings. And that's what is going to drive equity prices. So we tweaked our S&P target up slightly. We're saying people to be invested, stay invested, because even in a sloppy market, there are always some opportunities. And we see them in the healthcare area. We still see it in technology, although valuations are not as cheap. They're cheaper than they were, but at least there's growth, and that's encouraging. So some of the more defensive areas on the market, dividend focus on stocks that are providing yield, and high quality, companies that are sustainable and that have a long-term future. And I think that's where you want to be, is like avoid the risky parts of the market. And as long as the global economy holds together, commodities can actually perform quite well. And but you have to be selective on the commodity side. I mean, things like copper, gold, for example, silver, uranium. You saw, Cameco up today 10% or so. I mean, there's going to be a huge shortfall in uranium production over the next few years, and that's going to be sustained, and that's going to drive uranium prices even higher. Because, demand is just soaring, and whatever the U.S. is trying to do, including China and the rest of the world, it's the most reliable renewable source of energy that we can find. So it's relatively costly because there's a big embedded cost up front. But we're moving towards modular reactors as well. So there are areas where we're going to be able to make some money. I mean, including maybe a little bit less so in nickel, but lithium also has got a lot of upside potential. So there are areas in the market where we'll make some money. But right now we're focusing on gold. I think gold is a safe place to be.
I do have to wind it up, but I appreciate you joining us on The Close today. Pierre Ouimet is head of investment strategy at UBS Canada.